Welcome to Talk Tickers. So Eaton's latest earnings report really sent the market on a wild ride. On one hand, you had a solid beat on earnings. On the other, guidance that looked like a miss. So what's the real story here? Well, we're going to unpack the long-term strategy that the market is just now starting to get its head around.
Okay, so here's the whole conflict in a nutshell. For Q4, Eaton knocked it out of the park, beating earnings expectations with $3.33 per share. But, and this is a big but, their full-year guidance came in at $13.25, which fell short of what Wall Street was really hoping for. It's that classic beat and lower scenario. So, what's really going on under the hood?
In this slide right here just shows you the market's initial confusion perfectly. The stock tanked, dropping over 5% in pre-market trading when the news hit. But then, as the day went on, something interesting happened. Smart money started buying that dip, and the stock actually closed in the green. You know, this price action is really our first big clue to the real story.
So let's dig into the bull case, shall we? Because the demand for what Eaton sells isn't just strong. It's, frankly, unprecedented.
The key number to look at here is the book-to-bill ratio. It's sitting at 1.1. Now, what that means is for every dollar of product they shipped out the door, Eaton is booking $1.10 in new orders. This tells us that demand is actually outstripping their ability to supply it, which, let's be honest, is a fantastic problem to have. And just to be clear, any book-to-bill ratio over 1 is a really powerful indicator of future growth. It means the company's backlog of orders is getting bigger, and that is a huge signal of forward momentum.
You can see that momentum crystal clear right here, a 31% year-over-year jump in the Electrical Americas backlog. This record backlog gives management an incredibly clear line of sight into future revenue and, you guessed it, a very high degree of confidence in their outlook.
And it's not just us saying it. CEO Paulo Ruiz really drove this home on the earnings call, describing the demand as, and I quote, extraordinary. He made it absolutely clear that this incredible growth is the foundation for their whole optimistic outlook. And this growth isn't coming from just one place. It's pretty broad-based. You've got aerospace orders up 11%, mega projects are up 30%, but the real headline grabber, data centers. Orders there have just skyrocketed by 200%, and you can thank the AI boom for that one. So this brings us to the million-dollar question, right? If demand is this strong, why on earth did they put out conservative guidance? Well, the answer lies in a pretty bold strategic move they're making. Look, Eaton is playing the long game here. They're pouring $1.5 billion into expanding their capacity to meet what they see as generational demand. Now, this means they have to take a short-term hit on their margins because they're taking on costs before the new factories are actually up and running and generating revenue. It's a necessary investment, though, if they want to capture all that long-term growth. And they were very open about the impact. Management said this is going to create a drag of roughly 130 basis points, that's 1.3 percentage points, on their full-year segment margins. The hit's going to be heaviest in the first half of the year as they're ramping up these new facilities. So this cost right here, this is the direct cause of that conservative guidance. Okay, so how does a company like Eaton fund this massive expansion while also trying to sharpen its overall focus? Well, the answer is a major portfolio pivot. The answer lies in a huge strategic shift. Eaton announced they're planning to spin off their legacy mobility group, which includes both their vehicle and eMobility segments. The whole goal is to become a pure-play powerhouse focused squarely on their two hottest markets, electrification and aerospace. And let me tell you, this move is a real game-changer. By spinning off the $3 billion mobility business, Eaton can now pour all its attention and capital into its high-growth, high-margin electrification and aerospace businesses. It's immediately accretive, meaning it boosts both their growth rate and their margins right away, and it just allows for much more focused capital allocation.
The timing of this move is absolutely key. The mobility group was a clear drag on performance this quarter, with sales down pretty significantly. So this spinoff basically removes that headwind right as Eaton is getting ready to accelerate growth in its core markets. It's a smart cleanup.
So you've got incredible demand, you've got smart investments, and a major strategic pivot. What's our take on Eaton? Well, here's the next call. Our thesis is pretty simple. The market totally got it wrong at first. That conservative guidance isn't a red flag at all. It's actually a green flag.
It's a sign that Eaton is investing heavily to capitalize on what looks like a multi-year AI-driven supercycle. So yeah, that's a bullish signal, not a bearish one.
So, based on all that, we think management has set a very, very conservative bar for the first quarter, and it's one they're well positioned to clear. I mean, their record backlog gives them a clear path to turn all those orders into revenue. We're predicting adjusted EPS of $2.87, which is above the high end of their own range, and organic growth of 7.5%, also topping their guidance. That stock's reversal on earnings day, that was just the beginning. We believe the stock is going to continue to climb as the market starts rewarding Eaton for its long-term vision. This is a company that's investing in its own future, and we fully expect the stock price to start reflecting that. So, with overwhelming demand, a really smart strategic pivot, and a clear path to beat expectations, our rating on Eaton is a resounding outperform. And just a final reminder, this analysis is for informational purposes only. You should always do your own research. This is not financial advice.